Welcome to another episode of the Australian Retirement Podcast. And as James would say, hello there, good humans.
Hello, good humans.
Yes, welcome, James. It's good to be here. Good to be in the same room again. It's been an exciting end of financial year. We're a few weeks moved on. I think we've all kind of settled down a little bit. But what's been happening? Feeling good?
Yeah, feeling really good. It's as you said, it was a big close to FY25, and now we're
physically and emotionally taxing.
Yeah, that's right. Yeah, we're in FY26, and
you could get the pens out doing notice. That's what I'm going to call them.
These are your notice of intent to claim and tax deduction forms. Yep. No, things are going really well, and life's good. What about you?
Is everything really going that well?
No.
I'm pretty sure we made a bit of a little not a wager, but maybe some sort of a wager. I'm not sure what the prize was for this. I think it was lunch.
No, it could have been lunch. It might have been something,
Rain
maybe
on the
coffee
maybe,
or something.
One of the nice restaurants in Melbourne.
You are, of course, referring to CBA. Yes, I'm not far from throwing in the white towel.
It's been a tough year.
So we're at, I think 154 is the neutral point, plus or minus a couple of dollars. We'll have to go back to that particular podcast to confirm, but it was about that number.
They say, shorting CBA or the banks is that they call it the widowmaker, for lack of a better term. And you felt that firsthand.
Yeah. Like I've managed to keep my marriage, but only just. It's a constant source of anguish at home. But yes, the CBA share price is currently $184 at time of recording, which means that it would have to fall a great deal.
That's off its high, though. It is off its high.
Oh, wonderful. Yeah, brilliant. Now, interestingly, I took the liberty of looking at the Morningstar ratings on this one very recently. And
up 45% for the financial year, just FYI, excluding dividends.
Really comprehensive review from Morningstar. I'm just going to extract the one key thing that supports my craziness. Our fair value estimate for Commonwealth Bank is AUD $98
$98. How are you coming out with $98?
Yeah. So the fair value estimate for Morningstar, from Morningstar's perspective, is literally 50% of the share price.
And this is a reminder why, when I think most of financial advisors, we don't just get one broker research report and recommend something, or one research report. It's all about, everyone has a different perspective, a different way of valuing and looking at companies. But it's always about finding multiple sources before you make a recommendation, not just relying on one.
Yeah, well, anyway, regardless, you're not going to rely on me moving forward, because I took a bet at the beginning of the year that the share price would be down from its 154 valuation, and it sure ain't. What's more, early on in the session, or like early on in this bet, I thought to myself, as CBA went up, I thought, oh, geez, I hope it falls. I hope it falls back down. It did for a little bit, and then it went back up again. But now, I don't hope it falls. I hope I lose the bet, because the pain of markets falling by 20 to 25%.
Which means CBA has to fall.
Correct. Yeah. The pain of that far exceeds the pain of buying you lunch wherever you want to go. So mate, this is open the white towel factory. It's time to wait.
And there's a couple of stories playing out here as well. Like, it's not just CBA. Yes, CBA is a magnificent company. We'll call it magnificent. Oh, maybe not quite the Mag 7.
It's hard to argue.
But there is the passive investor flows that are coming through. And there's also this tendency that if Australia is seen as attractive, overseas investors tend to buy an index, whether it's an Asia index or an Australia index. And CBA is now 300 billion. It's the biggest part of the index. So anyone adding net money into Australia broadly is buying CBA. And then you've also had a kind of some slight shift away from private markets in a lot of superannuation funds as well, and back towards listed shares. So exactly.
I'm fascinated, particularly by
how this turns.
Yeah. Well, but the fact that there is a natural overweight, we don't necessarily understand the magnitude, but there is definitely an overweight to the top 20 shares on the ASX 300, just because if you want to buy VAS, if you want to buy any A200, any of those sort of ETFs, they're going to have a truckload of purchasing for these particular positions, whether you like them or not. And the thing that fascinates me is I think back to 20 years ago, when, for a lot of you will know that my dad was a financial advisor, and I was
back in the heyday of financial advice.
Yeah, that's right. And we're having a conversation. We're away up in a place called Corryong in northeastern Victoria, and Dad was sitting out the front of his caravan, and I'd gone up to spend a bit of time with him. I could drive, which was a bit of a treat, and I'm older than that, by the way, but that's where we were, and so he was talking about investing, and I was talking about exchange traded funds and buying the index and the value of buying the index. And he asked then, aren't you concerned about the idea that over time there's going to be a bigger and bigger overweight to the bigger companies, and it's going to start to irrationally move them out? That conversation happened, if not 20, at least 15 years ago. That was a long time ago that the grass shoots of that observation were starting to happen. And this feels like, in many respects, without detracting anything from the CBA or indeed your bet, well played, sir, but this does feel like a lot of that is materializing in a really rapid way. I'm quite intrigued to see how this pans out over the next few years, because this could become a runaway train of sorts.
Yeah, and I mean, the thing I always lean back on is the fact that this isn't just just happening in Australia.
Yeah.
It doesn't matter what country you go to. The UK is worse. France, Germany, the US. The top 10 companies, top 20 companies make up a larger proportion of the index than they do in Australia. And yes, CBA is huge. I think it is easy to be on either side of this. It is easy to build a case that says you shouldn't index because you're just buying more and more of the expensive companies. And it's easy to build a case of the opposite that says, active managers tend to not outperform the index, so why would you bother? But I think the key and good financial advice is kind of bridging the gap between both. That I know in a few weeks ago, as to when this goes to air, Hamish Douglas, so founded Magellan some time ago, he raised, the article, I don't necessarily agree with all the things in there, but he did raise one point, and that's what if the share market goes sideways for a decade and you're holding the index? You obviously get a dividend yield, but if it's gone sideways, you're not getting the 10 or 11% that we've become accustomed to. And that's why whenever we talk to retirees about this, how do we build resilience into their portfolio? And that's where we don't take a side on index versus active. We actually try to combine the two to get the best possible experience and use all the tools that we have available. So I think in any of these issues, and I think you'd be exactly that, probably share a similar view, you don't need to take a side. It's actually about how do you blend these things together.
Agreed. Yeah. But I'm still lamenting the prospect of buying it.
My taste is going up and up as my CBA shareholding goes up and up. I had the pleasure, I never thought this would happen before. So we had a company offsite last week, and I was tasked with doing a presentation on AI to 40 people. Me, AI. It was called The Age of Intelligence, and my first line was, this. I never thought I'd be doing a presentation called The Age of Intelligence with my name on it. Didn't get any laughs, unfortunately. I thought it was so powerful and it was so interesting. So we, as generally a group of younger people, interesting to hear how people are adopting. So I just took the opportunity with Kev Toohey. If you listen to the Investors podcast, he's the one who came up with a really bad investment idea in our portfolio. Not in our portfolio, but in the fake model portfolios. But we actually took the opportunity to explain where we were using this to change our own lives. And you saw some firsthand experience before we were prepping for one of these podcasts as well. I found it really insightful at how it took. So my business partner was probably using AI or ChatGPT at the most basic level for a year before I was like, that's biggest waste of time. That's not proper writing. That's not proper work. And now I have 2 different AIs open at all times on my computer whenever I'm working. And it was interesting sharing and hearing from other people what they were still doing manually, using things like Copilot. Obviously, there's restrictions around privacy, but I found like this thing, and everyone's talking about it across financial markets, across technology companies. AI is like the most powerful thing. Even the government's talking about it. So I was interested to learn how other people are using it and how life-changing it has been just from a work perspective for me, but let alone for people at home. You can do everything with these. If you haven't, meal prepping, you could ask ChatGPT, I've got all this in my fridge. What would you recommend for dinner tonight? You can ask them to help you meal prep with 50 grams of protein and 12 grams of sugar from this menu. It's like and that's just the most basic uses of these things. Be interested to learn your perspective on how you're adopting AI.
Yeah, similarly.
Even training for a marathon.
Well, it'll go and do your runs for you.
Yeah, not
so
quite.
VO2 max has gone up this morning. Similarly, I think it's a fantastic resource, and we're using it more and more. It's really interesting how it intersects with financial advice. In that in a previous episode, we were talking about cryptocurrency and lamenting the fact that Australian financial services legislation can at times just take too long to catch up to the environment that it's in. And the byproduct of that is that financial advice can be left behind, or certainly not having the best opportunity to serve Australians. For those of you who have ever punched in a financially related question to ChatGPT or any other AI engine, you'll find that what it provides often is a pretty high quality synopsis of the situation.
Yeah.
I've used this looking at properties and saying, like, I'm looking at this particular property. Tell me about the development potential for this property, and it's not that bad.
It'll go get demographics. It'll tell you what average prices are.
It'll give you all the zoning. It'll give you the implications of the zoning. You can go as deep as you want. It's very, very good. Now, of course, there's no substitute for going and engaging the right professionals to cross-reference that, but as a first port of call, it's a very valuable one. Having said that, with the challenge that exists in financial advice, of course, is the personal identifiable information issue, which is that what we are not allowed to do, and rightfully so, is take someone's full financial information and drop that into a chat GPT and say, hey, what recommendations would you give? Even if we had also dropped in hundreds of other pieces of advice, so it had a good sense for the sort of advice that we gave. The reality is that if we did that, it actually would probably produce a fairly efficient, at least initial document. Yeah. But the issue is that we can't put personal identifiable information. We can't put your name and email and phone number and net assets. We can't put that information into an open AI engine because we don't know where that data goes, or that's the view of the Australian financial services legislation. We're not sure ultimately where that's going to go and whether it will ever be used poorly in the future. So we're now moving into this evolution, which I'm really fascinated to see, of where we have closed AI. Yeah. You have advisors have their own personal AI model whereby all of the rules of that AI engine are taken, but it's brought down into a box that sits in your office, so to speak, rather than a box that sits in the cloud. Yeah. And then that way, the thinking is, of course, when you ask questions, then all that information is still contained within your business. That is a really, really fascinating evolution for advice. And I hope and pray that we address it quickly, because we're talking about how to give advice to more Australians. And this is a really obvious way, like one of the most screamingly obvious ways for advisors to be more productive and to serve more Australians. So fingers crossed, although I feel like I say this a lot, fingers crossed some common sense prevails and we start to get some better outcomes in this space sooner rather than later.
That's where I was going to go with it as well. Like, the key here it is building more scalable businesses. It's not necessarily to make more money. It's actually to be able to service more people efficiently. So you can imagine having an internal chat that could identify similar clients to what you've executed strategies in the past, but only internal, which would take humans, could take humans weeks and months to be able to go through all those files, which just increase the ability to provide advice. But also with the overlay, that's just doing the part of the legwork for you, not actually doing the analysis and delivery and explanation, which I think is always going to be incredibly important and human. Speaking of tailored strategies, I had, I think, quite a few interesting experiences in the last few weeks as we pivot towards the Boomer briefing. Mm-hmm. Still settling into the title for this one. Haven't received too many complaints yet. One thing that kind of came across my desk or mind was in the short-termism that is kind of, and I think maybe part of this is coming from AI as well, where the knowledge of financial, of what you can do with superannuation is increasing. Yeah, great, financial literacy is increasing, but it can be resulting in short-term decisions happening. One example I had, and I'm sure you've had plenty similar, was this idea that the first opportunity you can get access to your super, you should take it. So, and I think the key and what concerns me is this: if we're going to start a TTR, transition to retirement pension, or if we're want access to our cash because we've got some kind of upcoming requirement, it's imperative that we're actually considering the impact and the trade-off that's going to have before we take that money out. You had similar experiences, similar thoughts?
Many times. Yeah. And I agree. I think part of it might, it's...
Because you can do all this yourself.
You can.
Without advice.
Yeah. I think that most people overestimate their behavioral patterns. Yeah. And they, like, for example, if we're thinking about setting up a transition to retirement pension, okay, I've turned 60 years old, I'm still working, but the idea of taking some money out of super now and doing whatever I want seems attractive. Number one, what is the broader impact of doing that? What does that mean for your long-term plans and trajectory? That it's not to say you have to go to an advisor for that question, but you need that question answered properly before you do it. But number two is most people that I've spoken to that, for example, want to sometimes sell down investments or whatever, and you say, well, what are you going to do with that money? And too many times I've seen people stray from their intended plan because humans are strange creatures, and we when we're tempted with funds, we tend to go and buy the boat or the jet ski or the whatever.
Keeping up with the Joneses.
That's right. Yeah. And so there's power in having that money locked away, so to speak, in an investment. Yes, you can get it in a couple of days by clicking sell and the money will be in your bank account. But the act of having that money out of sight, out of mind, and doing something means that it doesn't get spent. And that's one of the most valuable behavioral things that you can have as a human, because we're bloody good at spending money that sits in our bank account, right?
It's basically delayed consumption. Like superannuation is delayed consumption. You're forcing us to delay the consumption. And I think it's that part can be incredibly powerful. And then once you get this released, being like it is unique in, historically a lot of other developed countries would give you a pension and you're spending the income that comes out. But in Australia, we can get access to everything. We get access to it tomorrow. We control our destiny, and that is, one, great, and two, scary for me as a financial advisor. Maybe we pivot to the second point here, which is, and I think I see this way too often as well. And as much as we don't do lots of insurance, we do reviews and kind of needs analysis for when people come with insurance. We focus on retirement naturally. But do you find a lot of people set up insurance and never really look closely enough at it? And how often do you think insurance policy should be reviewed, particularly for those nearing retirement, so say 55 plus?
Absolutely. Yeah, this is something that I've almost reached the conclusion that if you retain an income protection policy all the way up to age 65, and you are in good health, you've made a mistake.
Yeah.
Because
and you have no debt.
Correct. But even if you did, frankly, the sheer cost of it is so enormous.
Yeah.
I can't help but feel that the pricing, the decisions behind the pricing at insurance level are that if you've kept this on your 62nd and 63rd year, you're going to keep it in your 64th and your 65th year, regardless of what the premiums are. Yeah. So the premiums can just get inflated to maximize profit for the insurer.
No point. If you're paying an insurance policy a year before you turn 65, and what's the payout for the policy? Usually up to 65.
Yeah, correct.
Like, what are you actually going to get for the massive premium that you're paying?
In most cases, especially sitting down with people that might be 61, 62, 63, and that you can convey it by saying, well, the per annum, the benefit that you're going to get here for a claim. Let's imagine we've got 1 year to go. We've got someone who's 64 or turning 64. You've got 1 year to go, and the total benefit that you could receive is something in the order of, let's say, $80,000. And your premium is $15,000.
Yeah.
So what that essentially the insurer is saying is that if we have a Groundhog Day for the next 12 months, just replay the next 12 months in every variant, just you start again. They're saying in around 7 of those times, you would find yourself unable to work like almost immediately and require all of that benefit.
Yeah.
That's preposterous.
Yeah, not going to happen.
It's so much. Of course, the probability is more likely as you age, but it's certainly not at that number. And so. So firstly, how often should you review your insurances? If you are above 55, the answer is every year.
Every single year.
Every single year. And you should review them 2 ways. Firstly, do I still need this cover? And that almost always comes down to completing what you and I know to be called a needs analysis, a proper numbers-based analysis of what actually do I need to cover.
Yeah.
And then number 2 is a policy analysis, which is that given the premiums that I'm paying for this specific policy and operating under the assumption that I could rewrite the cover elsewhere, does this specific policy represent the best value for me over the next couple of years? Yeah,
and I think this is particularly, and I find it's actually people who are in a strong financial position that end up just keep on paying insurance even when they don't need to. And it could add thousands and thousands of dollars back into your cash flow for that year, which could be invested, which could be compounding. And that's where I think the fallback always goes back to. But I'd have to completely agree at 12 months, anytime after 55, 12 months. And a big review as soon as you're 55 or 60 or that first time you get advice is always a good time. And then look incredibly closely. Life, TPD, trauma, income protection. I've seen some incredible premiums come through. And as we know that there is still a commission paid for insurance premiums. It is capped, so there's no benefit of going from one insurer over the other, but there is still a premium, a commission paid, which means in some cases it can be, good for the insurance provider to keep that policy going as well, particularly if it's in the thousands and thousands of dollars.
Yeah, the insurance. The insurance provider always wants to keep the policy going forever. That's
or
that's
the advisor.
Yeah, they'd give it to you for the 66th year if the policy would allow. I think that definitely, well, hopefully, your advisor, whoever that is, there's someone, or most likely, if your policy was written that by an advisor or by an insurance broker, there is someone that should at least be able to give you that level of service to do a proper analysis and reach some conclusions. And it's very common for me to meet with a member who says, here are my insurance policies. It was written years and years ago by a broker. We've never had any communication or contact with them. And that is a shame. Although there's no legal requirement for that broker or that insurance or that financial advisor, for example, to engage with you and work with you. And so to that end, it's more than likely to be a reactive service rather than a proactive service. As far as I'm concerned, if they're still receiving a clip and a meaningful clip, might be 10 to 20% of the premium every year in order to simply just keep the policy on the books, which if they're not contacting you means literally do nothing.
Yeah.
Then if you get in touch with them to say, hey, I'd like to evaluate whether or not I need this cover anymore, I would very much like to think that they should be open and amenable to that. And if they're not, that's a code. That's the deepest of code reds for me.
The AI should be able to help with that for them anyway. Like if there's a policy coming up, reach out and contact the client that's paying you. It's kind of, let's not annoy too many financial advisors.
Thanks for watching this episode of the Australian Retirement Podcast. I'm Owen Rask, the founder of the Rask Group and Chief Financial Officer of Rask Invest. One of the great things about retirement is you get to switch off your active income and move into a mode where you rely on passive income from your investments. This can be a daunting time for a lot of people. In fact, most people in our community will seek financial advice at this time in their lives. So if you're watching the Australian Retirement Podcast, you should know that we have resources to help you find a qualified and vetted financial advisor. To get in touch with one of our financial advisors or partner advisors, you can head to the YouTube description that's below the video and simply click the link to get taken to a page where you'll find lots of resources for finding a financial planner. We've even created a matching tool which matches you to an advisor that we think may be suitable for your stage of life, your assets, or your goals. And you can also find resources on how to verify financial planners and their qualifications. It's all available in the link in your YouTube description. Let's get back to the show.
And now's the time when we switch to today's big question. I was trying to come up with a good fake name, but the question comes from Axel, so I was going like Bobby Axelrod or there's no Axel. Is there like a Guns N' Roses or something? Yeah, Axl Rose. Maybe we'll go with Axl Rose. Unless you can think of another Simpsons-related one. This comes up all the time, and I think it's this inherent nature of yourself and I included, of not wanting to pay any additional tax than we need to, and not wanting any of our family to pay any additional tax than we need to. So Axl Rose asked the question, how does the recontribution strategy work for retirees? I essentially want to ensure that my children don't have to pay any inheritance tax when I die, and I've heard that this type of strategy can reduce or remove this. James, over to you.
All right. Hey, Axel.
Let's define what's a recontribution strategy, and it probably links to the Boomer briefing we had earlier too.
Yeah, I think so. All right. Well, let's perhaps split this into a couple of different things. Firstly, let's talk about what is a recontribution strategy. Let's talk about why it works, and then let's talk about who should practically make this a priority, who should look at it. The recontribution strategy is taking money, lump sum amounts of money out of your superannuation fund. So of course you need to be able to meet a condition of release to do that. So typically you'd be at least 60 years old and or retired. You take a lump sum amount out of your superannuation. Sometimes it can be the entire balance of your superannuation. That goes into your cash account, your day-to-day banking account, and then you recontribute that money back into superannuation.
And it can be a lump sum or a pension, but generally one's better than the other. That's probably an issue for another episode. Yeah.
Yep, agreed. Yep. So if let's imagine, for example, we've got someone who has a $300,000 superannuation balance. They are single, their expenses are quite low, and they have adult children.
Yep.
In that scenario, they say, right, well, my superannuation balance, most people's superannuation balance will have some tax associated if they are to pass and the money get paid down to adult children. So to eliminate that, I'll get to that, mate. To eliminate that, you could withdraw that full $300,000 into your own name, and then you could make a super contribution using the bring forward rule. You put in $300,000 as a lump sum, so your super balance goes back to $300,000. But by taking it out and recontributing it, what you've done is you've washed out the likely tax that's going to be paid if it gets paid to a beneficiary.
Yeah.
So the way that it works, of course, and I'll hand pass back to you. This is the concept here is the difference between taxable and tax-free components. So do you want to speak to that, please?
Oh, thank you. You put me under the throw me under
I'm
the
happy
bus
to keep
for my own
going. I just don't want to prattle on for 15 minutes.
And this is first we have to say that once you're over 60, any income you take or anything you take from superannuation is tax-free in the vast majority of cases, unless you work for a public health. And there's always a proviso or a disclaimer. Just said proviso. But basically, every part of your superannuation is made up of one of two components. One of them is tax-free and one of them is taxable. Taxable tends to have come from super guarantee and salary sacrifice and concessional tax-deductible contributions.
Which are most of people's contributions.
Yeah. So anyone that's been contributing since, for a career, whether it started in the 90s or the 2000s, is going to be mainly in taxable. And then your tax-free component is your non-concessional contributions, as James was saying. The after-tax contributions, the bring forward contributions that you can make. And where the sting here is that every dollar that you take out of superannuation, whether you're in accumulation or pension phase, will include a certain percentage of taxable and tax-free. So the earnings are applied to your balance, and your balance keeps evolving as you make contributions. Once you start a pension, it is crystallized. And then the amount that's taken from that pension account will have a percentage of taxable and tax-free. And your accumulation naturally can keep changing if you're still making contributions, if you're making taxable contributions, tax-free. So what we're saying here is that you can make that, say in your example, you can draw that $300,000 and there's every likelihood, let's just say all 300 was taxable, which may be the case on a balance like that.
Yep, often is.
From a career. So what would be the tax benefit of withdrawing that 300 and then putting the 300 back in? From the perspective, one, let's be clear, there is no contributions tax on non-concessional contributions. And there is no, if you're over 60 and obviously condition of release, there's no tax on the amount that you're taking out of superannuation. So there's no cost associated with doing it. He's pulling the Excel spreadsheet out to do this math incredibly quickly. Can you talk about the tax benefit of just that simple execution for an adult child?
Yeah.
Including the Medicare levy.
Okay. We're just going to keep one-upping one another with harder and harder questions, are we? All right. So are you happy with 17%?
I'm happy with 17.
Great.
Very happy with 17. That would be the 15%. So this is the interesting part as well. So the contributions tax rate is 15%, but it's not actually a contributions tax rate. It's a tax rate of superannuation. And that's where the 15 comes. Mm-hmm. And where does the extra 2 come from?
Medicare levy.
Medicare levy. There we go.
So in a practical sense, so now you've got this person who we're going to call Tim.
Yep.
And Tim, if Tim were to pass with his superannuation as it is, $300,000, all taxable component, then 17% tax would be applied to his adult beneficiaries, which would be $51,000 of tax.
There you go. I thought you were just doing that off the top of your head. Good job.
Welcome. Yep. And so that means $249,000 would go to the beneficiaries.
Yep. And that's regardless of whether it's paid by death benefit or through the estate.
It could be the money could be directed to the will first. However it goes, if it goes ultimately to the beneficiaries who are both A, adults and not financially dependent, B. So if you've got a 25-year-old that still lives at home, they're likely to be exempt from that. Except that does create some...
Stay at home, kids.
Yeah, that's right. That does create some complexity because sometimes you have, for example, you might have children that are financially independent and children that are financially dependent. Yeah. And so now they're actually getting different entitlements if you were to pass. But regardless, we've got 17% tax, which means $249,000 would go to the beneficiaries, his adult children that are not financially dependent, and the other 51 would go as tax.
Yeah.
Now, conversely, if Tim were to... It was Tim, wasn't it?
Axel.
Yeah,
Axel Rose.
No, that's going to confuse me. He asked a question. Yeah, no,
Tim. All right,
I don't want Axel to die. All right. So if Tim was to cash out that $300,000, and importantly, of course, that means he needs to A, meet a condition of release to take the full balance, and then have the ability to recontribute, which would mean that he's under 75 years old. Yep. He puts that same $300,000 straight back in. So in a matter of less than a week, it's gone out and back.
Some platforms let you do it.
Yeah, instantaneously. Yeah. So in that scenario, we have immediately gone from 100% taxable component to 100% tax-free component.
Yep.
And therefore, if Tim would have passed thereafter, the tax is zero. It's 0% because 17% tax still applies to the taxable component, but there is no taxable component anymore.
Yeah.
The reason why there's no taxable component anymore is because when the money was taken out of the superannuation fund, well, then that's neutralized. There's now zero balance. And when Tim recontributes it, he's recontributing it all as a non-concessional contribution, which we discussed before. That would be tax-free component. So this can be really, really beneficial for a whole raft of reasons, but the predominant ones being, of course, that ultimately it's going to give the highest likelihood possible that your adult beneficiaries are going to receive your inheritance or receive that money tax-free. Now,
You can pay for your fees with that.
Yeah, easy. Yeah. Now, conversely, there's also, better yet, maybe we should move across now to who should focus on this, because as far as I'm concerned, I think, for example, if you've got a couple who are running through their retirement assets quite quickly, they have a much lower need for this than a single person who lives off the smell of an oily rag and whose superannuation balance is not likely to change over many, many years, let alone someone that's sick.
Yeah.
So can I confirm, what's your take on this?
I mean, a lot of the time you use it for larger balances, or you can actually use it when it's not as perfect, but even when you're evening up, like it's something to consider when you're evening up balances between spouses as well. If one has a lower balance, naturally, if you're making large non-concessional contributions, it may not be perfect, but you can significantly increase their taxable component by pulling from one fund, particularly if Div 296 comes in and contributing to the other fund. So we use it a lot at that end, more generally. And it is like $50,000 on a $300,000 balance. And that's not maybe if you say it's like 85% average in concessional, it's impactful for everyone. And this is one of those, like, people ask the value of financial advice. These are one of those quantifiable benefits that you can provide by seeing an advisor who can execute it properly and do it quickly. Yeah. But definitely we tend to do it more for the evening up of balances or the kind of early retirement single people. Yeah. Where there's great benefit.
Now, there's a few other points to add here, if I may. I've spoke before about couples and said that might not be so relevant. And my reasoning for that is that regardless of the taxable or tax-free component, your spouse will inherit that superannuation benefit tax-free,
no matter what,
because they're considered to be what's called a tax dependent.
Yep.
So that's why for adult children that are not financially reliant on you, they're non-tax dependent, and that's why they pay the tax.
Yep.
So I think it's a lesser risk when you've got a couple, because it's a reasonable assumption, while they're both still with us, that if one is to pass, the money is going to go to the other, and it will go to the other in a tax-free environment. So therefore, there's not such a big concern. Now, similarly, if Tim unfortunately if his health was to deteriorate, single person, then that would also be grounds to go and see a financial advisor or get some advice before passing. And it's obviously an uncomfortable discussion to have, but if you were diagnosed with a stage 4 cancer or something along those lines, part of optimizing your financial affairs would probably be to withdraw your entire super balance, right? Imagine someone who's got a 1.5 million in super and it's all taxable component. We're looking at a walloping amount of superannuation here, of tax associated here, right? So in that scenario, I would typically advocate, let's get almost all that money out of super. Yep. Yes, that you're going to pay a little bit of income tax over this year, but your beneficiaries are going to have substantially less tax when you ultimately do pass. So really, it's going to be most beneficial for when someone, firstly, you're single, because then almost the money's going to adult beneficiaries straight away. Yep. A, and B, under the premise that they might die unexpectedly, which of course can happen when you're Australian, but if you were already sick, then you had time, you'd have the luxury of actually getting the money out and avoiding this anyway.
And the one last one, which we won't go into detail because it justifies another episode, is the Centrelink benefit, where you can use a recontribution strategy, not just to avoid inheritance tax, but to actually you maximise your pension benefit, where one partner is younger than the other and one partner is eligible for the age pension. I think that's a good one. Yeah, we should have an episode about that. Did that last week. It was it's unexpected, and when you explain to people, and it's one of the great parts of giving advice, when you say, "Oh yeah, we're able to do this." Whoa, that's great.
Yep. Free age pension.
Yeah, exactly. And I think good to reiterate here, we're not trying to fearmonger. This is the only inheritance tax that really exists in Australia at the moment. In other countries, it's as much as 45% of the assets, like the UK. In Australia, it's really only on that taxable component of your superannuation balance. But I think that's a perfect time to wrap up. James, it's been wonderful. You've given us a couple of really good nuggets of wisdom here. Maybe that's a new segment title.
Death and taxes.
As always, we love the questions. We can't do this without the questions that come in via the community, via the YouTube comments and videos, but also straight through the show notes and the Q&A entry you can put in there as well. So, James, thanks for joining me.
Welcome. Thanks, everyone. Tons of fun.
Yeah, and keep on listening.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.